Everyone, and I'd just like to introduce myself. So I'm Frank. I am in the team at Calculus Capital on the investor relations side, and we've been in the tax efficient investment space for over 25 years now. And we've recently brought to market an inheritance tax solution, which is what brings me here today to speak to you. And hopefully, through this presentation, you will learn a little bit about business relief. And on top of that, you'll learn a little bit about IHT and what you can now be doing for your clients in looking to protect them from inheritance tax moving forward. Okay, so we'll start with a bit of the risk summary. These slides will be shared at the end, so please take your time in reading through those. So just to go over what we're going to look at today, as I say, IHT changes, the evolution of business relief, some of the key recent changes, some of the key considerations that you need to be looking at, a complement, we'll leave that fairly vague, and hopefully that'll be interesting when we get there, and then some questions at the end if you have any. So first of all, why are we here? Well, the Chancellor has very much been eyeing up the riches that are there regarding inheritance tax, and we have seen year on year and month on month increases in the IHT receipts since the November 2024 budget. But this wasn't always maybe a household policy, and especially regarding business relief and its exemptions very much wouldn't have been a household name. But with the sort of farmer protests that were a couple of months ago, and some changes to pensions that I'll touch on in a lot more detail, this has very much been brought to the fore, and people are interested in this space a little bit more. So let's take a little step back and have a look at what business relief is. Business relief was first introduced in 1976 and has been supported by successive governments. It was established essentially so that local or small medium businesses that were family owned could be passed down to the next generation. For example, this might be your local butcher's shop where they wanted to pass it down to their child or children to run into the future. Over the years, the relief has been expanded to support investments in small and medium-sized businesses, and we'll touch on what they are shortly. So how does it work? Well, business relief reduces the value of qualifying holdings for IHT purposes, meaning less or no tax may be payable when those investments are inherited. So to qualify, investments must be in these unlisted companies or, and we'll touch on this in a bit more detail, AIM listed businesses carrying on qualifying trade. Now, there is a minimum hold period for these shares and holdings of 2 years. So an investor must hold these investments for at least 2 years before death for the relief to apply. Key to note here as well, there are some cases where investments have been held for less than 2 years but still qualify for the relief. This includes the pass of the holding between spouses, either on death or before, or where one qualifying investment has been sold and replaced by another. Now, what is the history of BR funds and IHT solutions? So 1996 was a significant year. Not only was it the year that I was born, but it was also the year that the government were able to change this and decided to increase the relief to 100% being business relief for certain qualifying assets. This change meant that the entire value of eligible business assets could be passed on without incurring any inheritance tax liability, significantly enhancing the attractiveness of BR, business relief, as a tool for estate planning. This decision was driven by a desire to provide greater support to family-owned businesses. As we touched upon, previously, it was brought in some guise to help these small, medium-sized businesses that were family-owned to be passed on without any penalty. So here it very much was, we don't want there to be any penalty. And this is because, as of the most recent study, 99% of UK businesses fall into the small to medium-sized category. Therefore, the government wants to help support them moving forward. Now, the increase to 100% relief reshaped the estate planning industry. So the likes of what I'll talk about later regarding calculus, these types of business relief products started to boom, and it was obviously very attractive for individuals that were looking to protect their wealth and reduce the amount of inheritance tax they would pay. So this substantial rise in use of BR came about as financial advisors started to look at this space in a little bit more detail. Now, it was especially attractive for business owners looking to preserve family enterprises across generations as well, without having the possibility of forced asset sales or tax-driven restructuring. So it really was a big move. It's also key to note here as well, with the change that came in 1996, this also covered EIS funds, with the shares in these EIS qualifying shares also being qualifying for business relief, and therefore that's what also drove a little bit more demand for EIS funds and EIS investment in general. Now, what are the changes that are coming up? So, from the 6th of April 2026, so as of the start of this tax year, the allowance for a single person for business relief is 2.5 million for 100% relief. So this has been changed around. It was well publicized as kind of hokey-cokey aspect of the government's position on this, with it initially being announced at just 1 million. And because of the fact that farmland also qualifies for business relief with agricultural property relief, this led to those protests by farmers and the decision of the government to up this to 2.5 million. And previously, this was that there was no restriction on this. It's key to note that investments above this allowance will receive 50% relief. So it's not as if that you're suddenly paying 100% IHT. There is still a 50% relief on that. It's also worth noting here as well regarding AIM shares. So the government did make a big change for AIM qualifying shares, and those sort of estate planning services that were using AIM qualifying shares for business relief, that these will now receive 50% relief regardless of the size of the investment. So that allowance of 2.5 million does not apply here. It is from zero. So anything that you have in AIM qualifying shares will only receive 50% relief on IHT. Now, what are the changes of IHT? So currently, the nil rate band is £325,000. So anything that you pass on as a single person to anyone else, your beneficiary, anything over £325,000, there is a 40% tax rate on this. There is £175,000 additional allowance if the main residence is left to direct descendants. And this is called the residential nil rate band. It's worth current rules. This can be passed to a spouse or civil partner, creating up to £1 million combined if the main residence is left to direct descendants. After this £1 million allowance, obviously this includes the residents as well, then 40% is charged on the above threshold. Now, it doesn't stop there. So this allowance is tapered by £1 for every £2 over a £2 million threshold. So those clients with a estate over £2 million very much should be looking at business relief as a potential investment to help shield their estate from inheritance tax relief. Now, changes from this year and next year. Now, the main one we're going to be talking about here is pensions. So traditionally, pensions sat outside of the estate for inheritance tax. With the reforms that are coming in, which is that pensions are now included in the inheritance tax estate, more pension wealth will become IHT exposed. And it's worth noting that the residential nil rate band only applies to residential property. Pension wealth does not qualify. So the big change here is that pensions are now included in IHT estates from April of next year. Okay, so you may be looking at this for the first time. You may have only used it a couple of times for clients, and you're thinking, right, I want to know the mechanics of how a BR fund may work. So the key thing to remember here is that we are the manager. If talking about calculus, or any manager, and then there is an underlying business that they are investing into. So the client invests with a BR qualifying fund manager. The fund manager deploys this capital into qualifying trading companies or company. Then this qualifying company or companies need to operate for 2 years. As we touched upon, clients need to hold these shares for 2 years, and then full relief is achieved after that period. Now, it's obviously key that these businesses continue to operate within the rules of qualifying for business relief, and they are run by the BR manager, and it's up to them to make sure that happens. So, one thing, and obviously the area most affected by these changes that we've touched upon is retirement. I'm sure a lot of your work is around retirement planning, etc. And pensions have long been a cornerstone of estate planning. They also were a cornerstone of IHT planning, but that loophole has now been closed as of April next year, as I've discussed. And from then, unspent pensions will move into a client's estate. So more people than ever will be risking leaving, a large amount liable to IHT. And what we've seen in the last year is that 2.3 billion was withdrawn from pensions, which is a 5-year high. And this is because savers have rushed ahead of the upcoming IHT changes. Now, there's a great impact on doing this. Of course, 25% can be taken tax-free, but if people have amassed a wealth in their pensions with the idea of passing this on, any additional withdrawals will be treated as income and taxed accordingly. This could push clients into a higher tax bracket, meaning a larger portion of their withdrawal is lost to tax. So moving forward, when planning for retirement and using pensions, clients should be looking at business relief as a way of passing on their wealth. So here's the opportunity for you advisors. Business relief does offer 100% IHT exemption, as we've touched upon, up to £2.5 million for non-AIM and 50% exemption for AIM qualifying business relief products. So the opportunity here is to reposition these assets. Potentially a client can take advantage of the 25% tax-free withdrawal from their pension, or it may be those slightly younger clients who are planning for retirement already and may now look at repositioning some of their investments and putting more into BR qualifying investments. Now, one of the advantages of BR is that clients can maintain access. We now know that 20% of people are living to 95. It may be that care costs need to be taken into consideration. Well, with business relief qualifying investments into BR funds, there is an element where they can maintain the access through liquidity, and we will touch upon the levels of liquidity later, but also control, which may not be there with strategies like gifting, etc. So yes, it really is time for IFAs and an opportunity for them to target BR products to help shelter clients' assets from IHT. Now we're going to have a little look at an example here now. So we're going to look at Margaret. So Margaret is making an investment. Now this money would already be outside of her, £1 million allowance if she was married and passing on the residence, or by herself without passing on the residence outside of the £375,000 estate. So example A, she invests this £250,000 into a portfolio of stocks and shares. Unfortunately, 2 years later, Margaret passes away. With a net growth rate of 3%, the value of this holding had grown to £265,000, just over, and the IHT charged on this to the beneficiaries means that the amount inherited on this portfolio was £159,135. However, if Margaret, may have been thinking about her estate and passing on her wealth, and she made this £250,000 investment into a BR qualifying fund or holding. Unfortunately, 2 years later, Margaret passes away. But because she had held these shares for at least 2 years, and because her investment falls within the £2.5 million individual allowance for this unquoted BR investment that she had made, her entire investment will qualify for relief from IHT. Now, this amount had grown to £252,471, and what we're taking into account here is a low growth rate of 3% and the initial fee of 2%, which again is actually quite low for the industry, that was taken at the start. However, there is no IHT charged. So the amount inherited is £252,471. You can see that's obviously, over £90,000 more on just £250,000 invested that has been saved from being paid by the beneficiaries in inheritance tax. Okay, so the title of this was to talk about, key areas to consider in building a business relief portfolio for your clients, but it may also be just key areas to consider when looking at investments for, or just a single investment into a BR fund for your clients. Now, the four areas that we're going to focus on are liquidity, valuations, the exposure of these funds, and the costs involved. Now, with liquidity, we really need to, look at the different options of liquidity that are in place. I spoke about this earlier regarding keeping control and potentially, obviously, needing to access the funds if circumstances change. Well, please do note that when you're looking at the different options of a BR fund or a BR provider, not to rely on match bargains, which means that someone can only make an investment in or withdraw if someone dies or is looking to invest. So if you're looking to withdraw, you need someone that's looking to invest. And if you're looking to invest, you need someone that's looking to withdraw or has sadly passed away, and therefore is taking advantage of getting that cash back. So you need to think, are there alternative redemption options available? Is the fund operating a highly liquid aspect with lots of cash coming through and therefore offering options such as regular buybacks? And that really will become more important with potential regulation change. Now, let's hope that neither of these happen in the immediate term, which is, so there may be changes to business relief or changes to the rates. Or, a third option is that if a new government were to come to power, now, it's the local elections for part of the country today, and we may start to see a shift in where the country is looking to vote. If someone then decided to, for the next general election, run with the manifesto of abolishing IHT, what will happen to such BR products? How are people going to get their money back? Now, this leads us on to the underlying assets. How quickly may someone be able to get this cash back? How quickly can a manager return these funds if people want to obviously move out from a business relief fund? And this also applies, I suppose, to general liquidity as well. What are those underlying assets? Is it a loan book? Yeah, fantastic. Wait for those loans to be repaid. And then, however long the loan terms are, whichever the longest term was, then all of the cash would have been returned and the fund can be wound down. Or it could be in other areas. And this leads us to the quote from the recent Sunday Times article that was written on some of the managers in the space at the moment. And what would happen, they ask, if they all wanted their money back at the same time? Now, this is just what we've been talking about. It is hard to sell some of these assets that they touch on here. For example, a wind farm, some of these renewable assets. It's hard to do that in a hurry. Now, what they don't talk about here in this quote is the option of a loan book and the liquidity that's offered there. So you really do need to have a look at those underlying assets as well. Now, valuations. We need to also consider how the valuation of these BR funds are done. So what we'll come on to talk about later on as well is target returns and etc. But obviously, as a manager, there we are in charge of the valuations. So you need to consider how these may be being done and completed and how the NAV is being worked out. So with private company valuations, they are subjective. So ask questions, how frequently are these valuations being updated and what a methodology is being applied? Again, we'll touch upon how loan-backed BR funds and loan books offer a greater price transparency in this regard. And that's because of, it's fact versus discretion. Physical assets such as renewable energy assets have their benefits for sure. But in terms of valuations, there is discretion in how they are valued. There's very much a range of how much value is there, and that can be decided upon by the manager. Loan book BR funds very much offer more fact in their valuation methods due to the discrete monetary values that are involved. And something else that needs to be considered regarding valuations is that some managers can link their BR funds to other operations within their wider parent company. And this obviously can cause a little bit of conflict, potentially, and transparency issues around the valuations that are there. Thirdly, we need to look at exposure and diversification. How is a client going to be exposed? How are you going to build their portfolio so they have a level of diversification? So most BR funds on the market concentrate in energy or property lending or SME debt. Now, sector concentration adds risk. So, if you are looking to build a portfolio, potentially look at one from each of these three or one of a couple of different options, which will also include a loan book. Or you might want that underlying asset to go with it, such as the renewable energy. Now, remember that all of these three that are listed on this slide can be sensitive to macroeconomic conditions. So finding a complement to them, which may be far less exposed to macroeconomic conditions, may be something that needs to be considered when building this portfolio or selecting which manager to go with. Now, costs. Personally, it was a year ago now, we started researching the sector as a whole, having only just launched the products at the back end of last year. 6 months prior to that, we're looking right. What is the industry offering? How am I going to be distributing this to advisors? And the thing that really struck me was the costs that were involved. And we'll talk about the calculus offering and how simplified that is later on. But please do look out for the level of arrangement fees. Now, this may also be called the initial fee. Some providers charge 2.5% to 5% upfront before deployment. Now, this directly erodes the amount eligible for relief. So that's why this is important. Please do look at that figure. If someone's charging sort of 4% upfront arrangement fee, then your client is only getting 96% of their total investments that will then potentially sit outside of the estate. Look at exit fees. Look at redemption penalties. If someone makes that investment, dealing costs up front can be there, but also when a client eventually exits, this may be on the choice to withdraw, or this might be that they're with their own when they sadly pass away, and then their beneficiaries go to redeem. There doesn't want to be, too much of a cost there to be incurred. So please look at that. And third and finally, which is the one that really struck me when I looked, is the layered annual management charges. Some managers will charge an annual management charge, not just to the underlying company, but to the client as well. So really look out if they are doubled up, and because that should not really be something that you should be advising clients on, because there's just a double cost involved. Okay, so we've covered now, I think, the educational side. So time for something a little bit more lighthearted. Now I appreciate we've only got a couple of people attending in person, but if you're watching this on the recording, I will reveal the answer at the end. So just going to have a quick quiz, and for those attending, if you don't mind speaking, or just pop it into the chat, and we'll just go through 3 little slides. But the question that I want answering from you is, what relates these 3 things? Conclave. Worldwide blockbuster. It won an Oscar and received over 300 nominations for film awards across the globe. Kneecap. Documentary covering a rather controversial Irish rap group, but very well received with over 60 nominations worldwide, and it won a BAFTA for Outstanding British Debut. H is for Hawk, a recent film in cinemas. It was BAFTA nominated as an Outstanding British Film, and really a great movie, with following a very serious storyline, but starring some big names. Any answers? Anyone got any guesses on what may link those 3 things? Okay, I'll go ahead and give you the answer, which is that they were all financed by the calculus inheritance tax solution. The calculus inheritance tax solution is currently the only business relief fund in the market built around media financing. So if you look across the wider unquoted BR market, there's a lot of strategy overlap. Most estate planning funds have some level exposure to either renewable energy, as I've touched upon, property lending, or SME lending. These can, of course, be effective strategies and are often blended together, but it can mean a client's estate planning portfolio can start to look quite familiar. Even when you're spreading investments across different providers, concentration risk can steadily build up with a client's estate planning portfolio, and it's often not immediately obvious either. So the calculus inheritance tax solution is doing something genuinely different, and is stepping outside of that traditional playbook and providing real diversification in this space, designed as a complement. Also, as you have just seen from the examples I open with, the end product is something people can actually recognize and relate to. These are often very well-known films and TV productions that clients can genuinely feel excited about and proud to be a part of. So why would you choose the calculus inheritance tax solution? Well, we've touched upon the portfolio diversification. But one thing to build upon our discussion on why valuations are important is that with this loan book style, so what we're doing, in making these secured loans is that these the these loans offer discrete data on monetary values that are there, and therefore the valuations are clear. And with that, there are predictable returns. Liquidity, again, an area we touched upon. Now, these loans are short to medium term, averaging 12 to 20 months. Therefore, we are seeing a lot of that cash back into the fund, meaning that we are able to offer different liquidity events. We do not rely on match bargains, so there can be regular buybacks put in place. And what this means is that if circumstances change, either for the client, either through regulation, and lastly, when it comes to redemptions, these withdrawals can be done very easily. Why else may you look at this solution? Well, the loans that we are making are against robust collateral. So the security that is taken, sort of 2/3 of everything that we've done so far has been UK tax credits. So what happens is, a film or TV production is being made, and in the UK at the moment, there is a very kind regulation in place for these productions that if they spend amounts, they then receive back Y as a tax credit, but that doesn't come until they've spent the money. There is an upfront production cost issue. So then they are able to receive those tax credits at the end, and that's what we will lend against. Or another thing that we lend against is sales contracts that are put in place with top tier broadcasters such as terrestrial providers or streamers such as Netflix, etc. Now, how that works is they will normally only give a little bit of the money that they've offered for the production up front, but actually they will then have an agreed amount once the production is delivered. Now, it does not need to be a commercial success. It purely has to be delivered, once filming has finished and edited, etc. And then the producers are entitled to extra funds at the end. And that's what we will lend against. And that is all fully secured as part of that lending process. Now, some other areas of why you might choose this inheritance tax solution. So there's diversification, not just from the client side, but also within the fund. So this is a portfolio of loans. This is dealing with lots of different producers every time, and they're all reputable counterparties. So there's a great level of diversification within the fund. And when we go to make those loans, there is a rigorous amount of commercial and legal due diligence that's put in place, to the point where we also put in place completion bonds, which is essentially an insurance, and some of them are underwritten by insurance companies to make sure that these productions are complete and delivered, so that those future revenues are repaid, whether it be the tax side of things or from the sales contracts with the leading broadcasters and streamers. So we have two options for clients, or they can choose one of them. So we've got the Alchemy Fund, which targets a return of 3%. So this is the fully secured loans, as I've touched upon. Or a client can choose Alchemy Plus. Now, Alchemy Plus targets a 4% return, and 25% of its operations is in gap financing. So 75% is the exact same as Alchemy, and 25% is in gap financing. Now, gap financing is lending on potential and future sales contracts. So, for example, if a film like Conclave has been sold to the UK, Europe, and Asia, but hasn't yet been sold to America, we get that estimated. Might be, let's say, £20 million if they were to sell it to America. Generally, in production, there is a gap in terms of how much financing is needed to produce it. After we've done our secured lending and there has been money put in by the likes of Netflix at the beginning or someone like that, we might lend on that 20 million around this kind of 5 to 10 million mark. We work with professional sales agents who estimate this amount of how much it can be sold for in this territory, and then we will take a significant haircut on that figure to the point that we will lend. So what we're able to do there is charge higher rates, etc., and larger fees, which gets that target return up. So clients have the choice. They can target 3% or they can choose 4%, and then they can go in chunks of 25% allocation in between. So they might want to do 25% alchemy, 75% alchemy plus, 50-50 or 75-25. The client can choose on that. Now, just a little bit of history on calculus's role in media. I touched upon earlier on our general experience, having been in the tax efficient investment space for over 25 years. And we've been looking to launch a business relief product for some time. In 2019, we won a pitch to run an EIS fund alongside the BFI, having pitched against many other providers. And we set that up and ran that for a couple of years before working out that we wanted to just build that investment style into our overall strategy. So we are now investing in production companies themselves, so not the individual productions, the actual companies that put it all together, as part of our VCT and EIS funds. And therefore, we saw the need for this secured lending, and we took over a fund in 2024 of Alchemy Limited, and have now launched this for fundraising. Alchemy Limited has backed over 125 projects in its history and partnerships with leading studios and broadcasters. We've touched upon some of the brilliant nominations and awards that they've had along the way. Now here you can see our track record since taking over Alchemy. We've grown it in 18 months, 8%. The NAV. We've financed 20 projects, deployed just under 24 million. And at the moment, we've got 12 more projects in the pipeline with a possible value of 24 million. What is interesting here is you can see what we are securing those loans against. So as I touched upon, 2/3 of European UK tax credits, but there is also the public broadcasters, streamers and distributors, and also an element of public grants. There's a film coming out later in the year that we financed called Out There, starring Michael Sheen. It's got a very Welsh cast. It's filmed in Wales, and therefore Film Wales, the public body, gave them a grant of £500,000. But again, that was delivered once it was produced, so they needed some money up front. So we were able to lend against that public grant. Now, costs. Costs really are something that you need to be taking into consideration. As I said earlier, it's something that I've seen that I think a lot of managers have made very complicated and taking a great deal of costs. Now, we want to make it simple. So the investor pays just two different types of costs. There's the upfront fee. Now, that is 2%, but for anyone from the Julian Harris network, I can do that for 1%. So please reach out and note that that is just a 1% upfront fee. Mention that you're part of the Julian Harris network, and I'm saying this generally for those that will watch it back on recording, and especially those that are obviously attending today. So that is just a 1% upfront fee. And then we have our dealing charge. So that's 0.5% on investment and then 0.5% on sale. So just a 1% overall dealing charge. And then the annual management charge is paid by the funds, the company. That's 1%. And so, when I touched upon earlier about how that can be layered for both, we are very much just levying that against the fund, the company that's operating. And then we have a 1% annual performance fee, and that's only paid if the 3% is met for Alchemy or 4% for Alchemy Plus. So to summarize, you're getting an inheritance tax solution from a firm that has gained experience in tax efficient investment over the last 25 years, and from a team that has been the dedicated lending team that has a unique blend of experience in both film and TV and managing such investments. You're getting secured loans with predictable returns and transparent valuations. And primarily, the main aspect here and why we have designed this as a complement is there is diversification of investment. So as BR funds have become more popular, as we touched upon, clients already have exposure to the main industries in the sector. And what you have here is a chance to diversify away from that. Or if you're making a new investment, have it alongside some of potentially those mainstay areas. And because we're offering an alternative approach to IHT solutions. Now, we know that Calculus has been running for a long time and operating a lot in this space. So if you have any questions on any of our other products, please do bring those forward as well. Okay, well, thank you very much for attending and listening. If you have any questions, please now bring those forward, either speak them out or put them on the chat, and we can basically go from there.
Looks like there's no questions there, Frank.
No,
Thank you.
all good.
All
Okay,
good.
well,
Thank you very much for your
thank
webinar.
you, Georgina, Dan. Thank you, Mohan, for arranging. When you've sent this out to the wider network, please, if there's any questions that they have, please do just send them my way. Happy to reply on email or set up a call.
Okay, that's fantastic. Thank you very much. Thanks, Frank.
Perfect. Thanks, guys.
Yeah.
Thanks for your time.
Cheers.
Thank you.
Bye-bye
Bye.
now. Bye.